Hi there and welcome to this video. My name is Andy Rowe and this is trendfollower.co.uk. This video is one of a series of videos that I'm making about how I'm trying to have a long-term wealth building strategy, which I also know as buying or creating my own hedge fund. And I've been talking about investing in a number of different asset classes in previous videos. I've discussed investing in the stock market, I've talked about investing in property, I've talked about investing in gold, I've talked about investing in commodities, and in this video I'm going to talk about the next asset class which I think we should all consider, and that is investing in fixed interest investments or bonds. But first of all, let me say this video is all about me. It's what I'm doing. I'm not a financial advisor. I can't give you advice about what you should do. So if you choose to do what I'm doing, then of course you do that at your own risk. I can't be held responsible for any investment decisions you make. So I'm happy to share my thoughts, but it's only on that proviso. So with that having said, here we go. Fixed interest, so lending money essentially is what we're talking about now. Before I was talking about buying property to perhaps rent it out or to hopefully get an appreciation in capital value, but now we're talking about bonds, and this is where I would effectively lend money to get a return of interest. So I could lend money to a company that wanted to have some money to develop their projects, or I could lend money to a government that needed money to fund some of its projects or pay its social security bill or fund the NHS or whatever. So these are known as bonds, and it's possible to buy these directly from companies. You can buy a bond that's issued by a company and pays a certain interest rate and will be paid back at a certain time. But most people don't go anywhere near doing that. Most people will buy bond funds. In other words, bonds that have been grouped together by a fund manager, such as iShares or Vanguard, or Fidelity, such as I've mentioned in the past. And so if I were to buy a bond fund, then I would be buying debt that's been issued by a variety of issuers, so companies or governments, or a mixture of the whole lot. And most of the time that's what I would be interested in putting my money into, and that's a mixed variety of debt, so that I'm not putting all of my investment into one basket. Now, traditionally bonds have been seen as a safe haven, unlike stocks and shares, which sort of go up and down rather more. Bonds are seen as less volatile. The theory is that essentially, particularly debt that's issued by safe countries like the US or the UK, the bonds are seen as being pretty much risk-free, certainly compared to shares. So traditionally they're seen as safe havens, and so what happens with many pension funds is that as the person whose pension it is moves closer to retirement, more and more of the pension fund is shifted from risky shares into safe bonds, and so the percentage of the fund that's in bonds tends to increase as the person gets older. But are they really safe? I think that's really the question, and it's becoming increasingly clear that some countries can't afford to pay back their debt. So, for instance, Greece is in the headlines at the moment because they're struggling to pay their debts, and they're trying to renegotiate their debt. And so the worry is, if you lend your money to a company that then defaults on its debt, that you won't get your money back or your interest either. So generally speaking, countries and companies where the risk is perceived as higher have to pay a higher interest rate to borrow the money. So if I were to lend money to a country that was less solvent, I would get a much higher return on my money because I'm taking a higher risk, but there's a risk that I won't get my money back. Now, over the past few decades, the countries like the UK and the US have been perceived as pretty much risk-free, and so a lot of financial calculations about risk have been based on that assumption that UK and US bonds are risk-free, but they may not be. And one of the problems is that we have an aging population, and so there's an increasing stress on the whole system. Countries are less able to afford to pay for things. We've got lower working populations, more retired people, and so there is a perception that countries may start to default on their debts. The other issue is that bond prices tend to rise as interest rates fall. So if, for instance, bonds have been issued at, say, 10%, and then over the next few years the interest rate drops away, that 10% return is very valuable. So the value of that bond rises. And that's been happening over the past 20 years or more, is that interest rates have been going down, so bond values have been going up. And at the moment we're at a point in time where interest rates are there's a historic low, and so one of the problems with buying bonds at this point is that if interest rates rise, then bond values will tend to drop. And one of the things that concerns me about buying bonds, particularly in 2015, is that maybe in 2025, if I've spent £10,000 on some bonds, 2025, maybe that £10,000 will be worth less than £10,000. So that's my concern about buying bonds at the moment. And I've never been a big fan of bond funds. I've never really bought much in the way of bond funds. So I'm speaking on this video a lot of the time theoretically. So there's this issue of risk. Now, obviously, different countries differ in how risky they are. Some nations are debtor nations. In other words, they owe more money, or they owe more than they own in assets abroad, and some countries are net creditors. So maybe it's a good idea to buy bonds from companies that are relatively well off, and maybe they're less likely to default on their bonds. And there is a company called Stratton Street who issue a bond fund which is made up of bonds issued by countries that are wealthy, so countries that are net creditors. So these will be countries like Germany, Singapore, Hong Kong, and so on. So that's something that might be worth looking at. So certainly I've looked at that with this issue of buying bonds, being a bit nervous about countries defaulting. So I certainly think the wealthy nations bond funds are worth looking at. And indeed, I do have some money invested in Stratton Street Wealthy Nations Bond Fund. It's issued in a variety of denominations. You can buy it as dollar denominated or sterling denominated as well. Depending on the platform that you're buying it through, you might be able to buy it in other denominations as well. Bond prices tend to be much less volatile than stocks, and in other words, they go up and down less. And this is an interesting graph here. I've taken the Vanguard Total Bond Market. This is an exchange traded funds that's issued in the US, and essentially it invests in US government bonds. So what are perceived as investment grade, very, very low risk bonds. Now, whether they really are very low risk is another matter, but certainly over the past X number of decades, they have been perceived as low risk. So this is a kind of spread of bonds within one fund. It's an exchange traded fund, so you can buy and sell it on the stock exchange. Its ticker symbol is BND. Now look at this this black line. This is the price of it. So the graph here is starting in 2007 and goes through to this year. Actually, I put 2014, but actually it's 2015. Living in the past. So you can see that essentially this this fund has gone up just a little bit, 10%, in 7 or 8 years, which is not much. Now I've compared that to the Scottish Mortgage Investment Trust. If you remember when I was talking about stocks or shares, this is an investment trust. It's the UK's largest investment trust, and so it invests in a variety of shares all around the world, and you can see how much better over the past 7 or 8 years Scottish Mortgage Investment Trust has done than the total bond market fund. But the point is, back in 2009 it did loads worse, and so it's easy to look at this graph and go, well, of course it's much better to be invested in Scottish Mortgage Investment Trust or in shares, if we kind of say this basically represents the stock market, because it's done so much better over the years. Well, yes it has, but actually at one point it did loads worse, and that's the point, is that shares are much more volatile. They can go down as well as up, and this is the pain and this is the pleasure. Bonds on the other hand did go down. You can see there's a little dip here, but not by anything like the same extent as the investment trust, which basically represents the stock market. So is buying a bond fund a suitable strategy for the long-term investor? Well, certainly I'm not brilliantly persuaded that it is. Certainly over the past 20 years I have not been invested in bonds at all, but now I'm 50 plus, I am starting to look at owning bond funds, and as I mentioned earlier, I do have some investment in a bond fund. But is it something that I would advise my kids to do? Well, possibly not so much. One of the things that might be worth thinking about, I think, and I do look at this idea as well, is owning an investment trust that's kind of bond-like, but has a little bit more growth. And there's an investment trust called the Personal Assets Investment Trust, PNL is its ticker, which I think is worth considering. 30% of the assets of this investment trust are in bonds. They're in US and UK index-linked bonds. In other words, when the inflation rate goes up, then the return that they give will go up as well. So they're kind of inflation-proofed bonds, which makes them well worth thinking about if we're concerned about inflation, and I think many people are concerned about inflation. 40% of the assets are in blue chip shares. So these are shares, very large companies, the biggest companies in the world, both in the US and in the UK. So blue chip stocks, which probably are going to vary in price rather less than some of the more modestly priced stocks. 10% of P&L's assets are in gold, and 20% of P&L's assets are in cash, and currently it yields 1.6%. So there is a yield on it, which is always good. I mean, 1.6% isn't a massive yield, but it is yielding something, and it does have some bond-like properties. So I've taken the same graph that we were looking at earlier, and I've added the Personal Assets Investment Trust to the graph. So the yellow line is the Scottish Mortgage Investment Trust. That's the one that did very well, but also did very badly. The black line is the Vanguard Total Bond Market Fund ETF, which has done very modestly, hasn't really done much at all. And the blue line is the Personal Assets Investment Trust performance, and that over that sort of 7 or 8 year period has returned about 35%, so much less than Scottish Mortgage. But look here, when the stock market dived, well, property dived as well, but when the stock market dived, the value of the personal assets investment trust went down much less than the Scottish Mortgage Investment Trust. So the personal assets investment trust has some bond-like qualities to it, which I think make it worth considering as a kind of proxy for bonds. We could use that as a sort of bond investment. Now, another alternative would be to look at peer-to-peer lending. Zopa.com. If you lend money to other people through Zopa, you'll spread your risk to a variety of borrowers, and Zopa reckon that on average you'll earn about 5% lending through them to other people. Now, you can't do this sort of investment or lending through an ISA or a SIP, as far as I'm aware. So really, I'm not going to consider this as a massive alternative to what I've been talking about before, because really I'm interested in having my investments tax sheltered in an ISA or in a pension, a self-invested personal pension. So really that's about it with bonds. So far we've got basically 6 asset classes. I talked about having some money in shares through an international general investment trust or an international ETF. I talked about having some money invested in property, again through an investment trust or through different ETFs. I've talked about gold. That was the video last time, I think. I've talked about commodities, how they can be a very valuable investment as well. Today's video has been talking about investing in bonds, and of course it's always possible just to hold money as cash. Now cash is still an asset class, so just having a lump sum of money in an ISA fund as cash is worth thinking about, because one of the values of having cash is that when stock markets are plunging and falling down, if one owns cash, you're not so affected by a downturn, of course, but also it makes one more able to pick up some bargains, and that's really where people like Warren Buffett have done so well, is buying stuff at a discount. So owning, having some cash in the old investment plan is probably well worth considering. So the next thing is really how to put it together. Again, I can't advise you how to do this, but what I'm going to do in the next video is talk about how I'm putting it all together and managing it, because what I'm after is a really simple, low stress way of investing, one that makes lots of sense, one that becomes automated, and that there's a little bit of a plan too. So again, it's all about me. I'm not telling you what to do. This is just what I'm doing, or what I'm thinking about doing, what I have done in the past, what I'm thinking about doing in the future. So today's been about bonds and fixed interest investments. Food for thought. Watch the next video, the last video, because it's going to be about how I'm putting it all together. Okay, thanks for watching. Bye for now.